I've said that I expect the oil price to be $70 by July. My model has it slightly higher than that, so I'm pretty confident about the $70 call. But the most interesting thing to me is what is happening to both the S&P 500 and the US corporate bond market. I think there's a lot more happening in the US equities market than just Donald Trump. Firstly, you've got a quite amazing recovery in earnings that has begun and is expected to continue until the end of next year. Now, we had a slowdown in the US economy last year. Growth dropped down to 1.6%. It's expected to pick up to 2.3% this year and 2.7% next year. The reason that happened was because that slowdown happened last year was ostensibly because of the fall in the oil price, which reduced a lot of investment in non-residential construction, that is to say, oil drilling, refinery work, construction of oil and gas pipelines, that kind of stuff. But it was really, that in turn really happened because there was a very dramatic contraction of fiscal policy by the US Congress. And the budget deficit fell by 7% of GDP over a period of 5 years, which is simply staggering. And that generated a slump in commodities, it generated a slump in the US economy. Now, we're through the end of that period now. The US budget deficit is stabilized. We have ongoing moderate fiscal stimulus to the US economy. And what that's doing to the recovery of earnings is really quite spectacular. Operating earnings per share, 12-month rolling operating per share, bottomed out in the second quarter of last year at $98 a share. They are currently, including the last earnings season, they've risen to $106 a share. But they rise to $130 a share by the end of this year and $147 a share by the end of next year. And that means that if you take the base of quarterly operating earnings per share in the middle of last year, earnings will have risen, are expected to rise 49% in this cycle. And it's entirely obvious that the anticipation of that would lift equities markets. But there's a lot more than that actually happening, and it's happening in the corporate credit market. The fact that we've got that recovery in earnings is allowing a lot of US corporations to buy back their debt. And that means that even though US Treasury bonds are rising in yield, corporate debt, particularly investment-grade corporate debt, has been falling quite dramatically in yield relative to US Treasuries. Now, what that tells us is there's enormous increase in liquidity coming forward to be available to buy US equities. And so the advance in US equities is rising at a far faster rate than you would expect just from the increase in expected earnings alone. And I say, and it may provide some alarm to people in a article in the Investment Watch, that where the market is now is fully a year ahead of where you would expect it to be based on earnings per share and bond yield. But the reason that's happening is because of this flood of liquidity coming in through the corporate bond market into the equities market. So we have been used to living through credit crunches. Now, what we are living through now is a credit flood or a credit rush, where there is enormous amounts of liquidity, which is driving the market to higher than earnings based on earnings per share and bond yield. Now, on page 16 of the quarterly presentation, I show a model of the rate of change of the S&P 500 we can expect from the rate of change of this availability of liquidity. And I say that I think the market will run out of puff. It's currently about 2360 at around about 2600 in terms of the S&P 500. So that's significantly higher than we are now. But we should be aware that we're in a situation where there's an enormous amount of liquidity. In the 80s, we might have called this weight of money, and that's what's driving the market up. And to a small degree, it actually has a number of characteristics which are similar to the early periods of the 1980s. So this thing still has a way to play out. It's more happening than just Donald Trump, but we have a measure of what this liquidity is doing. But I draw your attention to it on page 16 of the presentation.